Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's Get Your Money Right segment, we have auto and homeowners insurance. Thanks so much for checking out the show. As always, we really appreciate it. Hopefully, you guys are enjoying the Get Your Money Right weekly segments, and you're doing just as the title says, getting your money right and getting your financial affairs in order. Today is going to be a relatively quick one. We're going to talk briefly about auto and homeowners insurance. And if you've been following along in sequence up until this point, there's probably certain action items that you've already taken. If this is the first time you're listening to the show and you've not gone back and started at the beginning of 2024 with the Get Your Money Right segment, I would strongly suggest that you do that. Because if you have, you've done things like setting up your high yield savings account, you have automated transfers going into that account, you've come across a couple different ways to track your expenses, and hopefully you've started doing that. You have a folder set aside for all of your tax document preparation type stuff. You have a list of debts. You've prioritized those debts. Hopefully you've begun paying those higher interest rate debts down as needed. We talked about investing. You're getting your employer match if you work for an employer and they have a retirement plan at work. You're setting up or have already set up transfers into your Roth IRA. You've looked at things like planning and protection, things along the lines of life insurance and disability insurance. You know the difference between group and individual coverages, all that good stuff, right? And now you're probably thinking, okay, I kind of sort of have things where I want them, or at least I have a path forward. I know what I need to be doing on an ongoing basis, but man, this is tough. I got money coming out of my checking account every month going into savings. I have money coming out going into a Roth IRA, this, that, and the other thing. Where can I possibly free up some cash and put some money back into my life? And that's probably a pretty good segue into today's show, because one of the main things I think not a lot of people think about sometimes, and I'm probably guilty of this a time or two in the past myself, is when you look at your insurance coverages for something that most folks are probably going to have, things like auto insurance if you have a vehicle, and then homeowners insurance, or for those that are renting, you may even have renters insurance. You're going to be looking at those coverages, and one of the things that a lot of people aren't thinking about is what's called your deductible. And there's a lot of terms that get thrown around in the insurance space, and I am not a P&C agent. I don't sell auto and homeowners policies, and so I'm talking to you as a financial professional, but also as a consumer of these types of policies. And so when you hear the word deductible, that's basically the amount of money that you're going to be on the hook for as the policy owner, as the consumer, as the client, the customer, whatever you want to call yourself, if you need to file a claim on one of these types of policies. And so a lot of times, for one reason or another, these, especially auto policies, have a tendency, at least from personal experience and what I've seen just in my own life, of having usually like a $500 deductible, which means in the event, let's say you had full coverage on a vehicle and you get into a collision, that you're going to be responsible for the first $500, and the insurance company would presumably step in and cover the rest of it, assuming it's a covered claim. Well, what happens if you simply take that deductible, the amount that you're on the hook for, from $500 up to $1,000? Or let's say it started at $250. What would happen if you took it from $250 up to $500? And one of the things that you'll see, and this is going to vary based on where you live and the insurance carrier that you're with, and some other items that they use for their underwriting purposes, but generally speaking, you're going to see as you increase your deductible, the amount of premium, which is what not you pay the $3 a month to this show, you cheap bastards, no, I'm kidding, to become a premium subscriber to the podcast, but the amount of premium that you pay or dollars that you're paying to the insurance company to have these policies in force. So you would notice, for example, that If you had a $500 deductible, so again, if you got into a car accident, you'd be on the hook for $500. If instead you said, hey, insurance company, you know what? I'm comfortable now because I've listened to the Real Talk Personal Finance podcast and I have some emergency savings and I've gotten rid of my high interest rate credit card debt and I'm starting to build my balance sheet, right? I'm comfortable with being on the hook for more than $500. In fact, I'm so comfortable that I would be okay being on the hook for $1,000, for example, and I would like a $1,000 deductible. But in turn, I want to see some cost savings for that, right? And so if you were to increase your deductible from $500 to $1,000, you would notice that in most cases, if not all, your premium, the amount that you pay to the insurance company for that policy, would go down. And that's where you really have to kind of do a little bit of shopping around and do a little bit of math to figure out what works for you. So you might notice, as I have, that in my particular case with the company that I'm with, going from a $500 deductible to a $1,000 deductible saves a fair amount of money. And to me, it makes sense. I'm willing to retain, if you will, a little bit more of that financial risk in the form of an extra $500 in my deductible to save more money on my premium that I am guaranteed to pay to the insurance company for that policy. And so personally, I have a $1,000 deductible on our vehicles for each one. Well, I could, if I wanted to, take it up even higher. I believe the next threshold is either $2,000 or $2,500 on the vehicle. But if I do that, the premium, the amount of money that I'm paying for these policies, the amount of money that I would save by taking my deductible up again, is really not that much. So in my opinion, it doesn't make financial sense for me to take on another $1,000 or $1,500 additional deductible amount to save a couple of pennies on my premium. So I'm okay with the 1,000. But again, going from that jump from 500 to 1,000, or you may notice, for example, from 250 to 500 or 250 to 1,000, you're going to save quite a bit of money. So that's a very personal decision. It's going to be a function of your comfort with risk, what the numbers look like, how much you would be saving, how much you actually have in savings. So you don't want to do something like this if you are paycheck to paycheck and have no savings to speak of, but you're trying to save some money and you take your deductible up to 1,000 and the next day you get in a car wreck and now you have to come up with 1,000 that you don't have. That's really not a good situation to be in. So you want to do this very thoughtfully, but it is something that you want to think about as you're making your decisions and reviewing your insurance coverages. The other thing is you want to make sure that your coverages are appropriate for your situation. So everyone's going to have a different opinion on this depending on, let's say, you have a very old vehicle. Some people will take certain types of coverage off of that. They might not have what a lot of people refer to as full coverage. They may have liability only, meaning that if they get in a collision and they don't have collision coverage on the vehicle, well, they're just going to go ahead and total it, but it's not worth very much at all anyway, so they don't necessarily care about that. Again, a very personal and situational specific decision that you need to think through. One thing that a lot of people will do, and this kind of gets into when we kind of transition towards the homeowners aspect of insurance, is oftentimes you'll hear about these umbrella policies. And an umbrella policy is typically tied to a homeowner's insurance policy. And kind of like the name says, it drops down in coverage in the event you exhaust your limits under your homeowner's policy to cover, certain types of claims. And a lot of people are very quick to tell you that you need to have umbrella coverage. And before I go any further, let me just pause here and say, as we always do, that we don't give any advice on the show. I am not a legal professional. I'm a financial professional, but I'm not your financial professional. So anything and everything we say on this show is for entertainment and educational purposes only. We don't give any advice. Always seek out your own professional for your own individualized advice based on your own individual situation. So this is not that. However, some people will be very quick to tell you that you need to have an umbrella policy. And you might be thinking, well, do I need one or do I not need one? Again, that's a conversation for you and your insurance professional based on your situation, right? And a lot of it is going to be a function of net worth. And we talked about that not too long ago when we went over the balance sheet and calculating net worth, right? A lot of that's going to be a function of net worth. A lot of that's going to be a function of, how much risk you're comfortable with or not, what the numbers look like in order to add that onto your policy. Generally, it's a few $100 a year. It's usually not all that expensive. And it can make sense for a lot of people depending on how your assets are structured. Now, it might surprise you, but I've actually done this analysis for our own situation, and we actually do not have an umbrella policy. And a lot of people are fairly surprised by that, But the reality is, in my opinion, the way that our affairs are structured, they're structured in such a way that I don't feel as though we have a large liability risk, with one exception, which gets back into the auto, which I'll talk about in just a second. But if you look at things like, for example, retirement assets, right? You might have a bunch of money in a 401k plan. Well, guess what? It's very much creditor protected. In fact, fun fact, you could file bankruptcy and still retain the assets in the 401k plan. It's protected from bankruptcy. It's protected from lawsuits. It's protected from a lot of different things. I'm not, for those that have listened to the show for a while, a big believer for most people in permanent life insurance, but there's a lot of people that do believe in permanent life insurance, and they store a lot of their cash inside vehicles like that. Again, another creditor-protected vehicle that may be conducive to that person possibly not needing an umbrella policy or not needing as large of an umbrella policy based on that. When you look at things like real estate, you might think, well, my goodness, we live in a very litigious society and you have rentals. Like, why the hell wouldn't you have an umbrella policy? And I actually had this conversation with my agent several years ago. And long story short, the rentals are usually owned not by us personally, right? It could be owned by an LLC. It could be owned by a trust. It could be owned by an LLC that's owned by a trust. And they have their own layers of asset protection that are part of that. And so my question to my agent was basically, hey, if I did go out and get an umbrella policy with you guys and something happened at one of the rentals and that's owned by an LLC, would that actually be a covered claim? And surprisingly, the answer was no, it wouldn't be, right? Because the umbrella is on you personally. So not to go too far off on a tangent, but there's different ways to look at this from an asset protection standpoint. And so the way I see it for the rentals anyway is that there's several layers of that. Number one, we use professional property management. That's one layer of protection. Number two, we keep them fairly highly leveraged, meaning that there's debt on the properties. There's not a ton of equity. That's intentional, not just from an asset protection standpoint, but also from a velocity of money and just a total financial standpoint if you're looking at just numbers and calculations and growing and building wealth and assets over time. So that's another form of protection, right? A lot of them are owned by an LLC, which in and of itself is a limited liability company. Then you have the insurance coverage on those policies, including landlord policies, which already have $1 million built in for liability protection, right? So you stack all that on top of each other, and for us personally in our situation, it doesn't really make a ton of sense to have an umbrella policy. And I'm going to go back to that one exception I alluded to a few moments ago, which is the auto. So I was toying around with this, and I think the biggest risk that we have is Cashflow King decides to have too much fun behind the wheel of the car and speed a little bit and kill somebody, right? And get in some kind of a lawsuit that way, for example. Well, I went ahead and took up to the maximum limits that we were allowed to take for liability coverage on the vehicles. And surprisingly, that was literally pennies on the dollar compared to buying an umbrella policy, which I would want to come into play and protect a situation exactly as that. In other words, it was way cheaper to simply increase the liability coverages on the auto policies than it was to buy an umbrella. And the whole reason I would buy an umbrella for us personally in the first place was for an auto type of incident. Now, if you have little kids, if you have a fucking trampoline in your backyard and you have, the family kids over and stuff like that jumping around, you may want to reconsider. You may want to look at the liability on your homeowner's policy. You may want an umbrella policy. If you keep a bunch of money in cash and it's in a brokerage account and you don't have a bunch in retirement accounts, you don't use permanent life insurance where it's creditor protected, you don't have assets in real estate that already have their own types of legal/asset protections, and you have a lot of money just kind of sitting at risk. Maybe you have a paid off home and you have a bunch of equity in your home, right? Those are all reasons that maybe you would consider getting an umbrella policy. So again, that's a conversation for you and your insurance professional, your own financial professional, your own legal team to really figure out what makes the most sense for you. So that's a little bit kind of off on a tangent on umbrellas, but coming back to homeowners and renters, quite frankly, truth be told, I was not responsible enough to get a renter's policy when I was a renter. So I cannot speak intelligently about that other than telling you that if you are renting and you don't have one, it's probably something you want to talk to your insurance company about. And from what I've heard, it's extremely cheap in terms of premiums. and you should be able to get the contents inside your unit covered, especially if you have things that you would want to be replaced, right? Maybe it's electronics, maybe it's furniture, televisions, laptops, things like that. So something to look into. For the homeowners out there, there's different types of homeowners insurance policies. I'm not going to get into all that, but there's HO3s and HO5s. If you're not sure, again, a great conversation to just walk through a policy review with your agent and say, hey, what kind of homeowners policy do I have? What does it cover? I've noticed that things have come up in recent times as far as housing prices and with inflation and construction costs and things like that. Do I still have enough coverage for, my residents? I noticed I went back and looked at my policy declarations on our homeowners, and there was actually a note on there that due to construction costs and inflation, that the coverage amount and the premium, both of those things went up by 6.3% due to inflation. Well, it looks like in this particular instance, that was automatically adjusted, and that's great. But what if your insurance company instead only adjusts your premium upwards, but it's for the same coverage amount? And if something happened and your house burns down, for example, that maybe it's going to cost significantly more to have that home rebuilt. So you might want to look and see and make sure that your coverage that you have on that homeowner's policy is still adequate, right? Another opportunity to have a conversation with your agent. And the other thing I'll mention, just going back to deductibles. So for homeowners, it's a little bit different. So personally, I'm willing to have a higher deductible on my homeowner's policy than I am on my auto. And it's a similar type of situation, right? You might go from a $1,000 deductible on your home to $2,500 to $5,000. And you'll notice, or you may notice, as I did, going from $1,000 to $2,500, there was a pretty significant savings in that premium that you pay the insurance company. In order to get that savings, you have to be willing to take on a little bit more risk in the form of a higher deductible. So I was cool with saying, hey, you know what? $1,000, I'm probably not going to file a claim for less than that. $2,500, I can still handle that, no problem. And I'm also probably not going to file a claim for less than that. $5,000, I can still handle it, but I don't save that much money compared to if I had a deductible of $2,500. So $2,500 was the answer, right? That may or may not be the answer for you. So again, check your own situation. But just a quick reminder to everybody to do a quick policy review. I would take the time to go ahead if you can log in. I know I like to log in online. I can pull my documents and review those. It's also a good reminder for those that may want to do a little bit of shopping. You would be surprised at, just sticking with the same company year over year. A lot of times that loyalty is not rewarded, and insurance companies are eager for your business. So you may want to shop around a little bit and see if maybe there's the same type of coverages out there that you could save a little bit of money on your premiums. So again, reminder to review your coverages, check your deductibles, check your coverage amounts, figure out whether or not you may need an umbrella policy. If you're a renter and you don't have renter's insurance, don't be irresponsible like I was. Maybe you should look into it and consider getting that. And again, just do a little bit of price shopping and see what you come up with. So that's your homework assignment for this week, should you choose to accept it, on the Get Your Money Right segment for auto and homeowners insurance. Check out what you have, see and make sure that it still meets and fits your needs. And if not, make some changes. And if it does, well, you know what? You can feel good about knowing that you've taken the time to do a policy review for yourself or with your agent for yourself, and that everything is exactly where it needs to be. So until next time, we will see you in the next episode.
Check the mic and make sure it sound right, boys.